For decades, income-minded investors have searched for the best dividend stocks out there. In my experience, the main criteria to look for when betting on great dividend stocks is a history of strong fundamentals, increasing dividend distributions over time, great entry points, technical, and a history of bullish trading activities in the shares. Let's check out best dividend stocks of 2021. Number 10. Enterprise Products Partners, EPD. Enterprise Products Partners is the largest publicly traded master limited partnership. The company provides midstream energy services, including gathering, processing, and storing natural gas. Overall, Enterprise is considered by most industry watchers to be one of the bluest of blue chips in this space. In an industry known for being run by risk-seeking cowboys, Enterprise has long been the buttoned-up, sober voice of reason. The company has always kept its debt levels reasonable, refusing to follow the path of many of its peers toward leverage-fueled excess. As of December, the company reported debt of 3.5 times annual EBITDA. Bank of America analyst Ujjwal Pradhan says Enterprise's approximately 30% drop in 2020 is a reflection of investors' lack of appreciation for high-quality yield within the mainstream energy space. In light of the stock's underperformance, management said it is shifting its priority from increasing its payout to ramping up share buybacks in 2021. Number 9. Enbridge, ENB. Enbridge is another top North American energy infrastructure company specializing in crude oil, natural gas, and natural gas liquids transport. Enbridge's 40-plus revenue streams give it the power to withstand a global crisis. When the economy recovers, oil and natural gas demand will return, and so will its cash flows. That was visible when Enbridge increased its dividend per share by 3% for 2021, despite the pandemic. While the stock is down 21% this year, its dividend yield is high at 8.17%. In another market crash, if Enbridge stock falls, its dividend yield will surge, giving you an opportunity to lock in a high yield. If you invested $10,000 in Enbridge in March, your money would have grown to $15,000 plus $875 in dividend income. Enbridge shares are down about 20% in 2020, but Morningstar analyst Joe Gemino says Enbridge's Line 3 replacement pipeline could drive significant upside by the end of 2021. Enbridge shares pay an 8.1% dividend. Morningstar has a buy rating and $43 fair value estimate for ENB stock. Number 8. Sempra Energy. Sempra Energy, SRE, $131.74, is a diversified utility stock that should benefit from current industry trends. The electric and natural gas infrastructure company is expected to get a big boost from its utilities business as we progress through the COVID-19 crisis. We expect higher residential electricity usage from increased work and learning at home to boost kilowatt-hour sales at Sempra, says Argus Research, which rates the stock at buy. Sempra also has been good to investors looking for income. Over the past 5 years, SRE has raised its dividend at a compound annual rate of 8.3%. The company has paid out $4.10 per share across 2020. Argus Research estimates the company will pay out $4.38 in 2021. Lastly, Sempra has a pretty attractive long-term growth rate for a utility. Number 7. Microsoft. NASDAQ MSFT has everything an investor would want in a dividend stock. The company pays a healthy 51 cents per share dividend, while it earned a $1.71 per share in its most recent quarter. That's a healthy ratio of paying out to shareholders while also keeping money on hand for investment. As one of the largest companies in the world, Microsoft has steadily increased its sales, and an especially attractive feature for dividend investors is its focus on recurring and subscription-based revenue sources. The company has a solid balance sheet with more cash than debt and a very low payout ratio that leaves tons of room to grow the dividend. Given its 18-year streak of dividend increases, we wouldn't be surprised if Microsoft joins the Dividend Aristocrats Club soon. Number 6. Apple. NASDAQ AAPL. Tech giant Apple has been paying dividends for only a few years now, which is understandable given the rapid growth it experienced in the early years of the iPhone and iPad. Companies tend to choose to reinvest profits into the business while in growth mode. Even so, Apple has an incredibly loyal customer base, and since its devices are designed to work well with each other, the company has a nice tech ecosystem that should keep its revenues strong. And Apple's rapidly growing subscription services business is providing a growing source of recurring revenue. Number 5. AT&T. Telecom giant AT&T has increased its dividend every year for almost 4 decades and receives utility-like steady income from its core wireless phone and high-speed internet customers. And the company's aggressive moves into entertainment could provide long-tailed growth potential. AT&T shares are down about 26% in 2020, but Bank of America analyst David Barden says the stock is the most unloved mega cap in the S&P 500. Barden says AT&T's subscription-based business model is fundamentally sound. The stock is also a tremendous value, priced at just 8.9 times projected 2021 earnings. Bank of America has a buy rating and $36 price target for AT&T stock. Number 4. Vodafone. VOD. Vodafone is the leading telecom company in countries such as Germany, Italy, and Spain. Vodafone shares are down about 13% in 2020. CFRA analyst Adrian Ng says Vodafone's Fit for Growth cost savings initiative is making a significant impact on margins, and the company appears well positioned to generate $7.3 billion in free cash flow in the 2021 fiscal year. Vodafone shares have a 6.2% dividend. CFRA has a buy rating and $19 price target for VOD stock. Number 3. Philip Morris International, PM. Philip Morris International is one of the largest tobacco companies and is the parent of brands such as Marlboro, Parliament, and L&M. Tobacco sales are relatively recession-proof, and Philip Morris shares have only slumped a bit in 2020, falling about 3%. Morningstar analyst Philip Gorman says cigarette volumes will likely continue to be pressured in the long term. Philip Morris pays a 5.8% dividend. Morningstar has a buy rating and $98 price target for PM stock. Number 2. Diamondback Energy. Diamondback Energy, FANG, $47.38. Currently sits in second place on this list of the analysts' favorite generous dividend stocks. Of the 33 pros covering FANG tracked by S&P Global Market Intelligence, 20 have it as strong buy and 9 call it a buy. Only 4 analysts rate it at hold. Not a single one says to sell it. Analysts point to the oil company's cost structure, asset mix, and financial strength as reasons for their bullish views. In our view, the company's relatively low cost of supply, the pros' long-term growth forecast is particularly bullish, with average annual earnings growth pegged at 13.5% over the next 3 to 5 years. At the same time, FANG trades at an inexpensive 9.7 times 2022 earnings. Number 1. ConocoPhillips. ConocoPhillips' October announcement that it would acquire rival Concho Resources, CXO, for $9.7 billion in stock only added to their ardor. We think COP is getting a good price for control of CXO and significantly boosting its Permian Basin acreage in the bargain, says CFRA, which rates COP at buy. A pending acquisition of Concho Resources is anticipated to close in Q1 21. If the deal closes as planned, we see COP benefiting from applying CXO's best practices in Permian development and from an expected $500 million in cost synergies. CFRA adds that CXO has the advantage of the large acreage position in the Permian Basin and has more time than most peers before significant long-term debt milestone payments arrive, further cementing its spot among the pros' favorite dividend stocks for 2021 was a rare dividend hike in the energy sector. a penny per share improvement announced for the December payout. Of the 23 analysts covering the stock tracked by S&P Global Market Intelligence, 14 say it's a strong buy, 7 say buy, and 2 have it at hold. They also see a solid year ahead for COP's shares. Their $48.09 average price target implies a respectable 15% upside in the next 12 months. Do let us know in the comments which stock you are interested in buying. Please subscribe to the Stock Advisor. Thanks for watching.